If Japan slips, the global system follows. Japan's economic model was sold as stability, but stability isn't free, and it never comes with instructions. For decades, the Japan financial system looked calm, while the world lurched from crisis to crisis. Low inflation, cheap money, predictable markets, it felt like the safe corner of the global economy. But that calm masked pressure building underneath, like a fault line under a quiet city. And right now, that pressure is already showing up in prices, markets, and global confidence. The surface story says Japan is unique and somehow immune to collapse. But economics doesn't care about reputation. It cares about math, incentives, and trust. Japan's debt, aging population, and Bank of Japan policy created stress fractures in the system. They don't shatter loudly, they spread silently until weight shifts just enough. And when that happens, the shock doesn't stay in Japan. It travels through energy, jobs, and markets worldwide. By the end of this video, you'll understand why the Japan economy crisis matters to your wallet today. You'll see how the yen collapse risks, bond markets, and supply chains connect into one fragile system. Most importantly, you'll understand why this wouldn't look like 2008, but could be harder to stop. Because the danger isn't panic, it's complacency. Stay until the end, because the final question might flip how you think about global stability entirely. Chapter 1. The silent giant everyone depends on. Japan doesn't dominate headlines anymore, but it quietly dominates balance sheets. While attention jumps to the US or China, the Japan economy crisis hides in plain sight. Japan is the world's largest creditor, lending to governments, corporations, and systems you use daily. Your pension, mortgage rates, and even tech stocks are indirectly tied to Japanese capital. So here's the uncomfortable question: what happens if that silent support starts to wobble? Japanese banks, insurers, and pension funds are embedded across the global financial system. They fund U.S. treasuries, European infrastructure, and emerging market growth. That means the Japan financial system isn't local, it's global plumbing. If Japanese money pauses or retreats, liquidity dries up fast, pushing prices and rates higher. This is how a Japan debt crisis quietly turns into global recession risk. Think of Japan like a massive utility company no one notices until the power flickers. As long as it works, markets feel stable and predictable. But the world economy collapse doesn't start with panic, it starts with hesitation. Investors reprice risk, jobs get tighter, and borrowing suddenly costs more everywhere. And the danger grows when this silent giant is forced to choose between itself and the world. Chapter 2. The debt trap that can't be escaped. Japan isn't broke in the dramatic sense, it's trapped in something worse. The Japan debt crisis isn't about missing payments, it's about never being able to stop borrowing. Debt sits at levels that would crush almost any other country overnight. Yet markets stay calm, prices stay stable, and nothing seems to break. So why does a system this stretched still look normal? The answer is the Bank of Japan policy holding rates near zero for decades. By buying massive amounts of government bonds, it suppresses yields artificially. That keeps the Japan bond market from imploding, but only as long as pressure never stops. Raise rates even slightly, and debt servicing explodes, draining budgets and crushing growth. This isn't theory, it's why higher global rates already strain currencies, jobs, and inflation worldwide. Picture a massive dam where the pumps can never turn off. As long as electricity flows, the water stays controlled, but maintenance costs rise, the structure ages, and the margin for error disappears. For viewers, this shows up as higher inflation risk, unstable markets, and tighter credit conditions abroad. And this becomes dangerous the moment confidence, not money, starts leaking out. Chapter 3. The yen breakdown and global shockwaves. A weak yen sounds like Japan's problem until it hits your wallet. The yen collapse isn't just a currency story, it's a pressure release valve for the world. When the yen falls too fast, capital doesn't wait around to ask questions. Money moves, hedges unwind, and volatility spreads across markets overnight. So why does one currency suddenly have the power to shake everything else? As the yen weakens, Japanese investors are forced to rethink global positions. They begin selling foreign assets to protect domestic balance sheets. That means fewer buyers for U.S. treasuries, emerging market debt, and global equities. Yields rise, borrowing costs jump, and liquidity tightens everywhere at once. This is how a Japan debt crisis quietly turns into global financial collapse risk. Think of the yen like a keystone in an arch, small but load-bearing. Remove pressure slowly and the structure adjusts. Remove it fast and everything above it shifts at once. For viewers, this shows up as market swings, weaker currencies, and higher energy and import prices. And the real danger gets much worse if Japan has to pull support from the system to save itself. Chapter 4. Manufacturing, Supply Chains, and Systemic Risk. Most people don't associate Japan with everyday shortages, but they should. Behind the scenes, Japan controls choke points the global economy can't reroute quickly. From precision machinery to advanced materials, Japan sits inside almost everything modern. Phones, cars, chips, medical equipment, none move without Japanese inputs. So what happens if this quiet backbone starts to crack? Japan dominates precision components that can't be easily replaced or rushed. Even China Plus One strategies still rely heavily on Japanese technology and tooling. If Japan's financial system tightens, production financing stalls and shipments slow. That delay ripples outward, factories pause, inventories vanish, prices climb. This is how a Japan economy crisis turns into inflation pressure and job risk worldwide. Think of global manufacturing like a relay race with perfect timing. Japan holds a critical baton no one else can grab mid-stride. If it drops, even briefly, entire supply chains trip over each other. For viewers, this shows up as higher car prices, slower tech launches, and fragile employment. And the real danger appears when financial stress and production breakdowns hit together. Chapter 5. The Scenario That Breaks the World. Global collapse doesn't start with chaos, it starts with doubt. The moment investors question Japan's ability to hold its own system together, everything reprices. This isn't about Japan missing payments or defaulting overnight. It's about confidence slipping in the Japan bond market. And once trust breaks, money moves faster than policy can react. If confidence in Japanese debt weakens, the Bank of Japan faces an impossible choice. Keep buying bonds and risk a deeper yen collapse, or stop and trigger a sell-off. Either path sends shockwaves through global markets and fuels global debt crisis fears. Bond prices fall, yields spike, and leveraged systems unwind across borders. This is how Japan's problem becomes a synchronized world economy collapse scenario. Think of Japan like the last person holding up a collapsing shelf. As long as they stay in place, everything looks stable. The moment they step back, the entire structure falls at once. For viewers, this shows up as market panic, political instability, and shrinking economic safety nets. And the scariest part is that Japan doesn't need to fall, it just needs to let go. This isn't a story about Japan someday, it's about now. The Japan economy crisis is already shaping prices, markets, and risk decisions globally. Understanding it helps you read headlines differently instead of reacting to noise. It explains why volatility feels constant and why stability seems thinner everywhere. This is about seeing pressure points before they turn into problems. None of this means collapse is guaranteed or unavoidable. Systems bend before they break, and policy choices still matter. But informed people adapt faster, whether that's in careers, investments, or expectations. Following bond markets, currencies, and global debt flows isn't optional anymore. It's how you stay ahead instead of being surprised.
Do you think Japan can keep holding the system together? What happens first if it can't? Currencies, bonds, or supply chains? And which country do you think would feel the shock fastest? Drop your thoughts in the comments. I read them all. Subscribe, turn on notifications, and keep learning how geopolitics, economics, and power shape your everyday life.